Here's a truth that will flip everything you think you know about trading. It's not your losses that destroy your account. It's your wins. While every beginner fears the red days, the real killer lurks in your green ones. Winners become addicts. Losers become students. This isn't motivational fluff. It's neurochemical reality. Your brain treats winning trades like cocaine hits, flooding your system with dopamine and quietly rewiring your risk perception. Consider Jake, a software developer who turned $5,000 into $15,000 in 3 months. Instead of recognizing beginner's luck, his dopamine-drunk brain interpreted this as superior skill. He quit his job to trade full-time. Within 6 months, he'd lost everything. His biggest winner, a $2,000 Tesla gain, became the psychological foundation for increasingly reckless bets that consumed his entire account. The pattern repeats with surgical precision across millions of blown accounts. Your evolutionary wiring celebrates successful hunts by encouraging bigger risks next time. In ancient savannas, this helped survival. In modern markets, it guarantees destruction. Each profitable trade whispers the same seductive lie. You're special. You've cracked the code. The rules don't apply to you. Early success breeds overconfidence. Overconfidence corrupts position sizing. Corrupted position sizing creates catastrophic risk. Professional traders fear winning streaks more than losing ones. Why? Losses force humility and rule adherence. Wins whisper dangerous suggestions about breaking protocols. A veteran trader told me, "My worst enemy isn't the market. It's my last 10 winning trades." They understand that the same confidence helping you pull triggers on good setups can destroy you when it morphs into overconfidence. Stop celebrating individual trades. Start building systematic protocols. Install one rule today. Position size determined by account risk, never conviction. Risk 1% per trade on your best idea and your worst day, period. This single constraint prevents the winner's curse from metastasizing into account destruction. Build friction against fantasy. Pre-trade checklists, exact risk calculations in dollars, rules for bidding size, increases after green days. The mathematics are unforgiving. Risk, 10% per trade instead of 2%, and 7 consecutive losses destroy 50% of your capital. But after winning streaks, that 10% feels conservative. Your brain demands bigger bets to generate the same neurochemical high. Easy money is a tell. It means you've stopped measuring and started dreaming. By the end of this journey, you'll transform from an emotional gambler chasing highs into a disciplined operator running a business. The stakes couldn't be higher. Ignore this shift, and your biggest win becomes the first domino in your inevitable collapse. You'll learn why the market's most dangerous lesson is that it's easy, and discover the warning signs before they poison your decision-making. Boredom is your edge. Excitement is your enemy. Compounding favors the low-variance operator, not the high-variance hero. If you crave the rush, the market will teach you the cost. If you crave mastery, it rewards restraint. The question haunting every trader: are you building sustainable wealth or feeding a psychological addiction that will eventually consume everything you've built? Your trading account is a mirror reflecting your deepest identity. On gambler days, you see a thrill seeker who needs to be right. On operator days, you see a builder who follows process. Which face placed your last trade? The next chapter reveals the mirror you've been avoiding. How your identity, not your information, determines whether your next victory builds your foundation or lights the fuse on your collapse. Your trading results are a perfect mirror reflecting your deepest identity. Chaotic traders get chaotic results. Disciplined operators get consistent profits. This isn't philosophy. It's measurable psychology etched into every tick of your profit and loss statement. The mirror doesn't lie, but most traders refuse to look directly at their reflection, blaming strategies, market conditions, Or bad luck while ignoring the behavioral patterns creating their results. The gambler seeks excitement, validation, and the rush of being right. They celebrate individual trades, increase size after wins, and treat the market like a casino offering entertainment. Picture Sarah watching an AAPL breakout, heart racing, already planning how to spend profits, doubling down when it fails because it has to work eventually. The operator pursues process, probability, and sustainable edge. They track monthly performance, maintain consistent sizing, and view the market as a business partner demanding respect. Marcus trades the same breakout with clinical detachment, predetermined position size based on account risk, taking his planned loss without emotional attachment. Your current results reveal which identity controls your keyboard. The identity audit forces brutal self-assessment through 5 diagnostic questions. Do you feel energized or calm during volatile sessions? Gamblers crave market chaos and adrenaline rushes. Operators prefer predictable patterns and systematic execution. Do you risk more when winning or maintain systematic position sizes? Risk escalation after wins reveals addictive patterns. Do you check positions obsessively throughout the day? Constant monitoring indicates entertainment-seeking behavior. Do you move stop losses when trades go against you? Rule-breaking signals emotional hijacking of logical systems. Do you feel disappointed when markets are quiet? Boredom during calm periods exposes the need for stimulation over profit. Install the breath and pulse protocol. Note your heart rate before entry. Elevated means postpone 5 minutes. Write 1 sentence before each trade. I am taking this because. If it includes prove, make back, or feel, you pass. State risk in dollars aloud. If you can't accept that loss without flinching, you pass. These friction points separate operators from gamblers. Your language betrays your identity. Gamblers say, I think this will moon, or I'm gonna crush this trade. Operators say, my system generated a signal, or risk-reward favors this setup. First-person predictive versus system-first conditional. Change the words, and you'll change the mind that speaks them. Environmental cues reinforce identity. Gamblers trade from bed, check positions on phones, seek social validation through trading communities. Operators maintain dedicated workspaces, use professional platforms, track performance through spreadsheets. Your setup reveals your self-concept. Remember the triad. Discipline executes rules. Patience lets setups come to you. Resilience absorbs variance without flipping identity. The market is a teacher with a ruler, not a slot machine. Show up as a student, get lessons. Show up as a gambler, get penalties. The brutal truth: you cannot consistently execute strategies that conflict with your core identity. Identity creates reality through feedback loops. Chaotic thinking produces chaotic results, reinforcing chaotic identity. But identity is changeable through conscious reconstruction. Here's the critical insight. There's a specific moment in every trader's journey when they unconsciously choose between becoming a professional or remaining a sophisticated gambler. It usually happens within the first 100 trades, during your first significant winning streak or devastating drawdown. The next chapter freezes that instant in place and shows you exactly how operators act when gamblers implode. There's a specific moment in every trader's journey when they unconsciously choose between becoming a professional or remaining a sophisticated gambler. It usually happens within the first 100 trades, often during the first significant winning streak or devastating drawdown. This moment arrives quietly. No flashing lights, no dramatic music, just you, your screen, and a decision that feels insignificant but determines everything that follows. Consider Sarah, a marketing manager who doubled her $10,000 account in her first month trading momentum stocks. Standing at her kitchen counter, watching NVDA gap up another 3%, she faced the fork in the road. Her system said risk $200 per trade, 2% of her original account, but she was up $10,000. Her brain whispered seductive logic. You're clearly good at this. Risk more to make more. She doubled her position size to $400 per trade, then justified it by calculating risk against her new $20,000 balance. That single decision created the neural pathway that destroyed her account within 6 months. When the inevitable drawdown hit, her 2% risk had become 4%, turning normal market variance into catastrophic losses. Or Marcus, an engineer who hit his first major stop loss on a Tesla trade, a clean $300 loss according to his rules. As he watched the stock immediately reverse and rally past his original entry, rage flooded his system. The moment of choice arrived. Accept the loss as cost of doing business, or revenge trade to get even. He bought back in with double size, no stop loss, determined to prove the market wrong. That emotional hijacking established the pattern that would consume his trading capital over the following year. These moments crystallize around 3 critical questions that separate operators from gamblers. First, do rules apply when you're sure about a trade? The gambler's brain argues that exceptional conviction justifies exceptional risk. The operator's brain recognizes that feeling sure indicates dangerous overconfidence requiring smaller, not larger, position size. Second, is your stop loss negotiable when the market moves against you? Gamblers view stops as suggestions to be moved when inconvenient. Operators treat them as non-negotiable business expenses. Third, does your position size reflect your account balance or your conviction level? Conviction-based sizing guarantees eventual ruin through variance. Account-based sizing ensures survival through inevitable losing streaks. The mathematics expose the trap. Risk? Well, 1% per trade and 3 consecutive losses draw down 3% of your account. Manageable variance. Let conviction push you to 3% risk after 2 wins, and those same 3 losses now consume 8.7% of your capital. Promise to size back down later. But later never arrives because the dopamine-drunk brain demands bigger bets to generate the same neurochemical high. Each micro-decision creates neural pathways through repetition and emotional intensity. Choose discipline once, and the next disciplined choice becomes marginally easier. Choose chaos once, and emotional trading becomes your default response. Your brain forms habits by carving deeper grooves with each repetition, especially during emotionally charged moments. Install the 5-second protocol. Before increasing any position size, count to 5 and ask, am I making this decision from logic or emotion? Emotion-driven decisions compound into destructive patterns. Logic-driven decisions build systematic wealth. Create if-then rules. If I hit 2 winners in a row, then I reduce size by 20% for the next 2 trades to counter euphoria. If I take a loss, then I take a 30-minute break and review my process. The brutal reality: most traders make their career-defining choice unconsciously, driven by neurochemical impulses rather than strategic thinking. But awareness creates options. Recognize the moment, pause the impulse, choose the operator's response. But here's what nobody tells you about these critical moments. Your brain is actively sabotaging your success, and it's not your fault. It's evolution's cruel joke on modern traders. Your brain is actively sabotaging your trading success, and it's not your fault. It's evolution's cruel joke on modern traders. That moment of choice from the last chapter, where you instinctively leaned toward greed after wins or revenge after losses, that wasn't weakness. That was your ancient neural wiring, optimized for hunting mammoths and avoiding predators, overriding rational intent. Your survival hardware treats probabilistic thinking as a luxury it can't afford. Your amygdala functions like a smoke alarm, while your prefrontal cortex operates like a spreadsheet. When trades go red, the alarm blares. drowning out mathematical logic. Stress hormones flood your system, heart rate spikes, and rational thinking shuts down. The same mechanism that helped ancestors escape charging predators now compels you to revenge trade, abandon stops, or double down on losing positions. Your dopamine system creates even more insidious sabotage by rewarding action over patience, creating addiction to trading frequency rather than quality. Every entry triggers neurochemical hits that reinforce behavior regardless of profitability. The Saboteur's Toolkit contains 4 primary weapons targeting modern traders. Overconfidence after wins represents the hot hand fallacy. Your brain interprets random success as predictive skill, encouraging larger risks precisely when humility is needed. This evolutionary adaptation once helped ancestors take bigger risks for bigger rewards during scarce times, but now destroys accounts through position size escalation. Revenge trading after losses demonstrates loss aversion in action. Losing $200 feels twice as painful as winning $200 feels good, driving irrational attempts to get even immediately. FOMO during breakouts exploits social proof bias, where seeing others profit triggers primitive pack-following instincts that override individual risk assessment. Action bias during quiet markets reflects evolutionary pressure to do something rather than wait, because inaction in dangerous environments meant death. Consider Tom, a software engineer who could debug complex code for hours, but couldn't sit through a 20-minute drawdown without adding to his losing position. His logical mind understood position sizing and probability theory. His emotional brain demanded immediate action to relieve psychological discomfort. Tom didn't lack knowledge. He lacked systems that disabled his impulse loops. The same patience that made him excellent at programming vanished when money was at risk because evolution never prepared humans for probabilistic thinking. Quick math exposes the trap. Suppose your planned system yields $30 expectancy per trade across 20 quality monthly trades, generating $600 profit. Your action bias adds 10 impulsive trades at negative $40 expectancy, costing $400. 2 revenge trades at negative $150 each eliminate another $300. Net result, negative $100 despite trading great. The edge existed. Biological sabotage destroyed it. Work with biology, not against it. Install if-then rules that trigger without debate. If you take 2 losses in a row, step away for 30 minutes and switch to half size for the next 2 entries. If heart rate is elevated pre-entry, wait 1 5-minute candle. Create mandatory cooling off periods after losses. Your amygdala needs 20 minutes to return to baseline before making rational decisions. Engineer friction against impulses. Require pre-trade checklists. Disable one-click ordering during market opens and closes. Ban position size changes mid-trade. You cannot overcome millions of years of evolution through willpower alone. Professional traders don't fight their psychology. They engineer around it through systematic protocols that make good decisions automatic and bad decisions nearly impossible. Professional traders don't rely on willpower. They build systems that make good decisions automatic and bad decisions nearly impossible. While amateur traders battle their emotions with motivation and mantras, operators engineer their environment to eliminate the battles entirely. The operator's code transforms gambling addicts into disciplined professionals through 3 non-negotiable rules that function regardless of psychological state, market conditions, or conviction level. Rule 1. Position size determined by account risk, never conviction. If your account holds $10,000 and you risk 1% per trade, every position risks exactly $100 regardless of how sure you feel about the setup. Your conviction varies wildly based on recent results, sleep quality, and neurochemical state. Your account balance provides objective truth. Calculate position size before analyzing any setup. Risk amount divided by stop distance equals share quantity. No exceptions, no negotiations, no just this once modifications. Rule 2. Stops set before entry. Never moved against you. Your stop loss gets placed when logic is clear and emotions are neutral, not negotiated when your amygdala is screaming about unrealized losses. Pre-market preparation includes exact stop levels for every potential entry. Once triggered, the stop becomes sacred. Violating it transforms you from operator back to gambler instantly. Moving stops against you is the gateway drug to account destruction. Rule 3. Profits taken according to plan, not fear or greed. Your exit strategy exists before you enter, removing psychological pressure from real-time decisions. Define profit targets based on technical levels, risk-reward ratios, or time-based rules, never on emotional comfort. Fear whispers, take profits now. Greed demands, hold for bigger gains. Your predetermined plan eliminates both voices through systematic execution. Implementation requires friction engineering, making destructive behaviors difficult and constructive behaviors automatic. Want to revenge trade after a loss? You must wait 24 hours and write a 3-page analysis explaining the setup, risk management, and expected value. Want to increase position size beyond your system? Calculate the risk of ruin impact and email the analysis to yourself with a 24-hour delivery delay. Most destructive impulses cannot survive engineered friction and cooling off periods. Create if-then protocols that trigger without debate. If you take 2 consecutive losses, reduce position size by 50% for the next 3 trades. If you're up 3 days in a row, implement a mandatory half-day break to prevent euphoria-driven overtrading. If market volatility exceeds 150% of 20-day average, reduce all position sizes by 30%. These rules function like circuit breakers, automatically adjusting risk when emotions cloud judgment. The mathematics prove the system's power. With a 1.5 risk-reward ratio and 45% win rate, your expected value equals 12.5 cents per dollar risked, positive expectancy that compounds over time. Risk 1% consistently across 100 trades, and you'll generate roughly 12.5% annual returns. Let emotions corrupt your sizing. 2% on sure things, 0.5% when scared. And variance destroys your edge through inconsistent execution. Habit formation transforms discipline from willpower into workflow through consistent repetition. Your pre-market routine becomes automatic. Review overnight news, identify key levels, calculate position sizes for watchlist stocks, set alerts for entry triggers. Post-trade routine, record entry reason, actual versus planned execution, emotional state during trade. This systematic approach builds neural pathways that bypass emotional hijacking. Environment design matters. Disable one-click trading, require pre-trade checklists, install daily loss limits that automatically shut down your platform. Use timers. 5 minutes of preparation before market open, 3 minutes of chart review before any entry, 2 minutes of post-trade notes before another order. Create a fortress around your capital, brick by brick, rule by rule. But even the best fortress needs strategic intelligence about when to engage and when to retreat. Markets are masters of deception, constantly generating chaos designed to trigger your worst impulses and break your systematic resolve. Markets are masters of deception, constantly generating noise designed to trigger your worst impulses and shatter your systematic resolve. The chaos arrives without warning. Surprise Fed announcements, earnings beats that gap down, geopolitical shocks that whipsaw prices in microseconds. Your operator's code provides the foundation, but chaos demands an additional defense layer. The chaos filter, your systematic approach to maintaining discipline when everything feels urgent and nothing seems certain. Picture 2 traders during Jerome Powell's surprise hawkish pivot. Trader A sees SPY gapping down 2% and immediately interprets it as opportunity, buying the dip with full position size, convinced the market always bounces. Within minutes, Algorithmic selling accelerates the decline another 1.5%, triggering his stop and consuming his daily risk before 10 a.m. Trader B recognizes chaos, implements his weight filter, and watches from the sidelines as the market thrashes for 3 hours before establishing clear directional bias. Same information, opposite outcomes? The difference isn't luck, it's protocol. The chaos filter operates through 3 systematic barriers protecting capital during market storms. First, time-based cooling periods after major events. No entries for 30 minutes following Fed announcements, earnings surprises, or breaking geopolitical developments. Markets need processing time to establish tradable patterns, not reactionary volatility. Second, volatility thresholds determining market participation. If ATR exceeds 150% of its 20-day average or VIX surpasses 25, reduce position sizes by 50% and widen stops to accommodate erratic swings. Third, do-nothing zones where preservation trumps participation. First and last 30 minutes of sessions, economic release windows, and low-volume holiday periods. Install specific chaos recognition metrics that trigger automatically. If 5-minute SPY candles exceed 0.5% range for 3 consecutive periods, implement 15-minute cooling. If sector rotation shows 3 or more sectors moving opposite directions simultaneously, reduce all position sizes. If your watch list shows 60% of stocks gapping beyond normal ranges, delay entries until patterns clarify. News-driven whipsaws represent your primary target. Tesla reports earnings, beats revenue but misses guidance, gaps up 3% then reverses to negative 4% within an hour. Amateur traders chase both directions, getting stopped twice. Professional operators recognize the pattern. Initial algorithmic reactions followed by human reinterpretation, creating untradeable volatility until dust settles. The protocol: wait for the second hour post-announcement when institutional flow establishes direction. Choppy consolidation periods test patience more than volatility. SPY trades in 2% ranges for weeks, generating dozens of false breakouts, trapping momentum traders. Your filter identifies these environments through compression signals. Daily ranges below 0.75% for 5 consecutive days. Volume declining below 20-day average. Price confined within prior week's boundaries. During these periods, reduce frequency 70% and focus only on mean reversion with tight stops. False breakouts disguise chaos as opportunity. Stocks break resistance on heavy volume, triggering momentum scanners, then immediately reverse as institutions use retail buying for exits. Prevention requires volume confirmation. True breakouts need sustained volume exceeding 150% of average, while false ones show spikes followed by immediate decline as smart money exits. Strategic inaction becomes your highest probability trade during chaos. While amateurs feel compelled to participate in every move, operators understand preservation during uncertain periods enables larger sizing during high probability setups. Missing 10 mediocre opportunities preserves capital for 2 exceptional ones generating monthly profits. Create if-then chaos protocols. If major news hits, observe 15 minutes minimum. If volatility exceeds thresholds, have position sizes. If heart rate spikes pre-entry, wait 1 5-minute candle. These automatic responses bypass emotional hijacking when chaos peaks. Remember the operator's chaos mantra. When in doubt, stay out. Your edge comes from selectivity, not activity. The sniper waits. The spray and pray dies. Sometimes the best trade is the one you don't take, preserving capital and emotional energy for genuine opportunities. But how do you quantify these genuine opportunities? How do you measure systematic effectiveness even during inaction? The answer lies in mathematical frameworks that transform gambling instincts into measurable advantage, the expectancy engine that powers every profitable operator's business. Behind every successful trader, lies a simple mathematical truth that transforms gambling into business: expectancy. This single formula separates professionals from sophisticated gamblers, revealing why consistency beats brilliance and small edges compound into generational wealth. While chaos filters protect you from market storms, expectancy quantifies whether your systematic approach actually generates profit. The mathematics are unforgiving, but they don't lie about your true edge. Expectancy equals win rate multiplied by average win minus loss rate multiplied by average loss. Consider two traders with identical strategies, but different psychology executing the same momentum breakout system. Trader A operates with discipline: 45% win rate, $200 average win, $100 average loss when following stops religiously. His expectancy calculation: 0.45 times $200 equals $90, minus 0.55 times $100 equals $55, generating $35 positive expectancy per trade. Trader B trades emotionally: 52% win rate because he holds winners longer, but $150 an average win because fear cuts profits short, and $250 average loss when he moves, stops, or revenge trades on tilt days. His calculation: 0.52 times $150 equals $78, minus 0.48 times $250 equals $120, creating negative $40 expectancy per trade. The brutal mathematics over 100 trades. Trader A generates $3,500 profit, while Trader B loses $4,200. Same strategy, opposite outcomes. The difference isn't market knowledge, technical analysis skill, or superior entry timing. It's emotional control during losses. Trader A's inferior win rate produces superior results because he manages the losses that destroy accounts. Stop worshiping win rate. Start building positive expectancy. Your edge compounds through frequency and time. A $35 per trade expectancy across 20 monthly trades generates $700 monthly profit, $8,400 annually on consistent sizing. Scale that edge across larger position sizes as account grows, and small mathematical advantages create substantial wealth. But negative expectancy compounds in reverse, creating monthly destruction regardless of occasional big winners. Install the expectancy audit to measure your current mathematical truth. Pull your last 50 trades, calculate win rate, average win, average loss, and expectancy per trade. Most traders discover they're not as profitable as they think because they remember big winners and forget small losses, creating dangerous overconfidence about their edge. The audit reveals whether your results come from skill or luck, and whether small improvements in emotional control can transform negative expectancy into sustainable profits. Understanding variance prevents abandoning profitable systems during inevitable losing streaks. Even positive expectancy systems experience extended drawdowns. 10 consecutive losses occur roughly once every 1,000 trades for 45% win rate systems. Your psychological preparation for variance determines whether you survive these periods or abandon profitable approaches at exactly the wrong moment. Risk 1% per trade with positive expectancy, and losing streaks remain manageable. Let emotions push you to 2% risk, and the same variance tests psychological limits. Create expectancy-based protocols that override emotions. If your system shows positive expectancy over 30 trades, never abandon it during losing streaks. If expectancy turns negative, immediately reduce size 50% and audit execution for emotional corruption. If expectancy exceeds your target consistently, increase position sizing gradually to compound the mathematical edge. The operator's expectancy mantra: I don't predict outcomes, I execute positive expectancy. Your job isn't being right about individual trades. It's maintaining mathematical advantage across hundreds of executions. Small edges compound into substantial wealth, while emotional inconsistency destroys even the best strategies. But mathematical advantage means nothing without the psychological foundation to execute it consistently. You cannot sustain positive expectancy with a gambler's identity addicted to excitement and validation. The numbers won't save you if the person placing orders seeks entertainment over profit. The final transformation from gambler to operator requires complete identity reconstruction, becoming the type of person who can maintain expectancy regardless of market conditions or emotional state. The transformation from gambler to operator isn't gradual. It's a decisive identity shift that happens when you finally accept what the market has been teaching you through every loss, every emotional hijacking, every moment you chose excitement over expectancy. Your mathematical edge means nothing without the psychological foundation to execute it consistently. You cannot maintain positive expectancy with a gambler's identity addicted to validation and thrills. The numbers won't save you if the person placing orders seeks entertainment over profit. The gambler's identity centers on excitement, validation, and being right about market direction. They celebrate individual trades on social media, refresh P&L every 20 seconds, and interpret losses as personal failures. Their language betrays their psychology. I crushed this trade. I'm gonna nail this setup. The market screwed me over. Every sentence places ego at the center of outcomes beyond their control. They trade from bed, check positions during family time, and seek social proof in Discord channels feeding their dopamine addiction. The operator's identity focuses on process, probability, and long-term edge execution. They track system performance through spreadsheets, make decisions based on predetermined criteria, and view losses as inventory costs, necessary expenses for accessing profitable opportunities. Their language reflects systematic thinking. My system generated a signal. Risk-reward favors this setup. The market provided execution feedback. They maintain dedicated workspaces, follow consistent routines, and measure rule adherence rates alongside profit metrics. Install identity reconstruction through 3 systematic approaches. First, language transformation. Replace first-person predictive statements with system-first conditional language. Instead of, I think this will moon, say, my momentum system shows bullish confluence. Instead of, I'm taking profits, say, my system hit predetermined targets. This linguistic shift separates ego from outcomes while reinforcing systematic thinking patterns that bypass emotional hijacking. Second, ritual implementation. Create pre-market routines reinforcing operator identity. 10 minutes scanning for setups, 5 minutes marking key levels, 3 minutes calculating position sizes, 1 minute centered breathing. Post-market rituals include execution quality journaling, focused on rule adherence rather than profit celebration, weekly expectancy audits, and emotional intensity scoring per trade. These rituals build neural pathways supporting disciplined decisions while crowding out gambling impulses. Third, environmental design. Operators maintain professional spaces with systematic watch lists, performance tracking visible at all times, and one-click trading disabled. They avoid trading from phones or social environments, triggering casual attitudes. Physical environment shapes psychological state. Treat trading like surgery, and your brain responds with surgical precision. Create friction against identity backsliding through accountability protocols. Want to revenge trade? Write a 3-page analysis explaining setup, risk management, and expected value, then wait 24 hours. Want to increase position size beyond system parameters? Calculate risk of ruin impact and email yourself with delayed delivery. Most destructive impulses cannot survive engineered friction and cooling periods. Expect identity resistance during transformation. Your old gambler identity fights for control through rationalization. Just this once. The setup is too good to pass. Rules don't apply to obvious winners. These thoughts represent dying gasps of gambling psychology. Acknowledge them without acting, and they gradually lose power over your keyboard. The ultimate test of identity transformation. watching a perfect setup pass by because it doesn't meet your systematic criteria without experiencing emotional distress. When NVDA breaks out on massive volume but occurs during your no-trade window, the gambler feels frustration about missed profits. The operator feels satisfaction about rule adherence. This psychological shift indicates complete identity integration. You've become the sniper who lets targets walk when wind and distance don't align perfectly. But identity transformation alone isn't enough to guarantee long-term survival. The final truth transcends individual psychology to encompass the infinite game of wealth building through mathematical advantage compounded over decades, where operators win not by being right, but by staying in the game. This final chapter synthesizes everything into the ultimate truth. Trading isn't about making money today. It's about becoming the type of person who can make money consistently over decades. While gamblers play finite games, seeking immediate rewards and quarterly victories, operators play infinite games, focused on staying in the game long enough for mathematical advantages to compound into generational wealth. The distinction determines everything. Finite players seek to end the game by winning big. Infinite players seek to continue the game by surviving variance. The mathematics expose the brutal reality and reveal the quiet power of consistency. A 2% monthly edge compounds to 26.8% annually through disciplined execution. Let's trace two paths. Operator starts with $10,000, generates consistent 2% monthly returns with maximum 4% drawdowns, and builds $126,800 in year one, $1.6 million in 10 years. Gambler starts with the same $10,000, swings between 50% gains and 30% losses, and despite occasional spectacular wins, trends toward zero through high variance and emotional execution errors. Same market, different identity, opposite destinies. The compound effect rewards boring consistency over exciting brilliance. Install the operator's manifesto as your daily identity reinforcement. First, I trade for process, not excitement. Your satisfaction comes from rule adherence, not profit celebration. Second, I manage risk, not hope for rewards. Focus stays on controllable factors, position sizing, stop placement, entry criteria, while accepting probabilistic outcomes. Third, I compound small edges, not chase big scores. Wealth builds through hundreds of 1% gains, not lottery ticket home runs, risking everything. Fourth, I learn from every outcome, not just celebrate wins. Losses provide feedback about execution quality and psychological state. Fifth, I build sustainable systems, not rely on temporary luck. Your edge comes from systematic execution, not market predictions or hot streaks. The identity shift creates exponential advantages beyond individual trade execution. Operators attract better opportunities because systematic approaches identify high probability setups others miss through emotional noise. They make fewer costly mistakes because protocols eliminate impulsive decisions during volatile periods. They compound their edge over time, while gamblers remain trapped in cycles of boom and bust, never building sustainable capital bases for meaningful position sizing. Install specific implementation protocols that transform philosophy into practice. Create a compounding log tracking monthly percentage returns, new equity high watermarks, and maximum drawdown periods. Score each session 0 to 10 on rule adherence, not profit and loss. Use if-then scaling rules. If 3 consecutive green months with drawdown under 5%, increase risk per trade by 0.25%. If drawdown exceeds 8%, cut position sizes in half. Build accountability through weekly performance reviews with one improvement focus per session. Engineer your environment like a professional cockpit. Systematic watch lists, performance tracking visible at all times, platform auto shutdown at daily loss limits. The market will test your resolve with surgical precision. It will tempt you with obvious setups during your no-trade windows, whipsaw your stops before reversing in your favor, and create winning streaks, whispering seductive suggestions about increasing position sizes. Every test represents a choice: maintain operator identity or revert to gambling patterns. But once you've truly made the shift from gambler to operator, you possess something more valuable than any indicator or system: an unshakable identity built on mathematical truth rather than emotional hope. Your trading success isn't determined by finding the perfect strategy. It's about becoming the type of person who can execute any profitable strategy consistently. The same momentum system that destroys gambling accounts builds wealth for operators through disciplined risk management. The infinite game continues beyond any individual trade, week, or year. Your goal isn't beating the market. It's staying in the market long enough for systematic edge to compound into financial independence. You now possess the complete framework for transformation. The question remains: will you choose the infinite game of sustainable wealth building or return to the finite game of emotional gambling? Your next trade reveals your answer.